Welcome, traders. In this video, we're going to go over the setup and use of these new ZoneTraderPro Divergence indicators. I've made a couple of videos about the preview of this indicator, but let's take a look at how it's used. First, in the setup, there's going to be two divergence indicators that we're going to be looking at. The first is ZTP Delta Divergence, and the second is the ZTP Special Divergence. Let's start with the delta divergence first. I've gone and preset many of these values for you. You definitely have to reconstruct the tape, and I have placed a minimum filter of 25. I set a reset time of 1800, which is the break in the contract time. We need to have divergence show enabled. We need to have accumulation distribution enabled. I want a 2.5 point zigzag, so I set 2.5 in the price deviation value. I want a 150 delta deviation contracts, and I want to look at 3 key points. I don't want to see its zigzag, but I do want to say show price plots and show key point data, because that's going to be the information we're going to see on the chart. And I want to change the zigzag plots to black. Black is what controls the numbers over here that you're seeing in the key points. If that's not changed to black, I think the programmer defaulted that to a light baby blue, and it's very hard to see. The other settings is the key point info, the price plots for bearish and bullish, and I always want to know when I have a failure, so we're going to show keep non-divergence. The next thing is I need to offset these labels, because probably one of the hardest things to see is the information that I'm putting on this chart, and you're constantly going and adjusting the chart so that you can see all the information. Again, I get it that there is information on the chart, but this is information that we need to know and understand. And then we want to enable the show delta plots down here. Because I'm making the video, I've turned off the alert. For the ZTP special divergence, they're pretty much the same. Again, I've gone and turned off the alert. If you don't have these wave files, you can find them on the blog, and I will put a link down in the description for that. Again, in the divergence, we want to show reconstruct tape. I'm giving it a smaller filter of just 10, again resetting this at 1800, and I'm also giving it a price deviation value of 2 points instead of 2.5. Show divergence needs to be checked, and unlike the other script, the non-divergent ones will show up automatically. So we want to give the non-divergent color a black. If you don't want to see non-divergence, you have the option to go up here and turn the color transparent. The other setting that to me is important is that I want to change the calculate for both of these to on each tick. Previously, I had this configured to on bar close and then on price change, but the signals weren't updating with a delay of a couple of seconds. And because this is a real-time indicator, I want the information in real time. So I've changed that to on each tick. Now, what you should do is when you are using this and the market is open, you should check your processor. And the way we do this is go to Control-Alt-Delete on your keyboard and bring up your processor, and you'll see that my processor right now, the overall processor is running at 6%, but the NinjaTrader is only using 0.3, 0.4% to do its calculations. So if during a regular trading day and the market is still 30 minutes from opening, I've tested my machine and seen that the processor is running at about 2 to 3%, which for me is acceptable. So you would want to look at that. The second thing that's important is to understand when these values recalculate for this accumulation signal that we have right here. As the market came down and tested, it would not recalculate unless we made a lower low. If we did make a lower low, what would happen is that the script would recalculate and it would move and continue to display when the bar had closed. So if, for example, on this bar right here, we had traded a tick lower, upon the close of the bar, this line would have moved to right there. It would have recalculated. If the numbers were still showing accumulation, then you would have received that accumulation signal, but it only occurs upon a bar close. So don't think that this is going to update in real time intra-bar. Now let's take a look at mechanically how these indicators work. There are three types of trades that we're going to be looking at. We're going to be looking at accumulation distribution. We're going to be looking at normal bearish and bullish divergence, and we're going to be looking at the special divergence trade. So for a trade that is bearish distribution or bullish accumulation, you're going to see the word distribution or accumulation above the line from where it goes from point to point. What is necessary to understand is that you don't actually receive this signal until you have a new zigzag. So in this case, you're probably not getting the signal until somewhere in this area here. Here is an example of a bullish accumulation, and the same goes for this trade here. You are receiving this signal when the new zigzag is forming right in this area right here. And that's when we're going to be looking for our order flow trigger signal into the buy that we have here. The second type of trade is no demand and no supply. And in a no demand, no supply trade, basically what we are looking at is this diagonal that is right here. And this is important because, as you see right here, when we made this trade, the smart money continued to sell off into the price rise here. And it's kind of important because what you're looking at is you're looking at the hour before the open right here. And basically this was telling you what the market was positioning, the way the market was positioning itself for the open. And we can use our numbers up here to see that from this point here to this point here, there had been net selling of a negative 114 from this point here. The KP3 number, which is based on this point right here, was a negative 1194. And before we go any further, let's take a look at what these numbers actually mean. The KP2 number is the number that we get from a low to a high or a high to a low. The KP3 number is the number we get from a low to a low or a high to a high. So it's very important that you understand this. The other thing that you need to understand is these numbers don't represent the entire number of contracts traded. These numbers represent the number of filtered contracts traded. So we are only looking for the larger lot trades, in this case 25 or more. Now if I was actually trading right now and I was looking at these as possible trades, this is the way I would have my charts configured. I would want a 5-range volumetric chart over here, and what I'm looking for is extension zones being created, one tick from the high, one tick from the low. So we see that down here we have, at the accumulation trade, we have that extension zone created one tick from the low, and at the high, where we have the no demand and the bearish divergence, we see that we have again created an extension zone one tick from the high. We also have probably the two most powerful order flow signals, the POC extension and the exhaustion trade. As price traded lower, we were creating even more extension zones into the open. What was also important to me is that when I am trading this, I do want to see the delta strength on the chart. So here with the delta strength, we have a 300 lot contract coming in exactly at the apex of this trade, and that's all for me I need to see. That 300 lot trader is most likely the person creating this extension zone here at 28.91.50 before the market sold off after the open, somewhat looking like 10 points. Now let's take a look at what these numbers mean as far as the KP2 and KP3 numbers. Like we talked about before, the KP2 number is the number of contracts that were filtered that were sold from this point here to this point here. So that number of filtered contracts was 1,080. The KP3 number, a negative 1,843, is the number of contracts that were sold, the difference in contracts that were sold from this point here to this point here. What we have is we have a higher price with a negative number of negative 1,843, and that's what gives us the idea that contracts were being accumulated. Now, I'm going to show another example of this. What you really need to be worried about in an accumulation or distribution trade is what the cumulative delta down here is showing us. And this is the reason why these numbers are just so important. So we look up to here and we see that the large lot traders were net sellers during this period right here to the tune of negative 114. But the large lot traders from this point to this point were putting in positions and pre-positioning to the open of a negative 1,194. So this is a pattern that you really need to understand, in that if this is an accumulation trade that we are taking, and there's no reason to view this as something that we wouldn't want to take, because this is a fairly big number of contracts that were absorbed in this KP3 number. What you really need to respect is these numbers up here, and because it's reflecting what the cumulative delta is telling us down here. If this was a true accumulation, you would have seen the buying support from the large lot traders as we went higher. But because it was not, and what they were doing is they were getting better prices, what you see is a continual sell-off in the large lot traders, giving us not one but two different divergence signals at this point. After I'd completed the video and got to the editing portion of this part of it, I realized there was an excellent way to demonstrate the power of what you're getting with the ZoneTraderPro cumulative delta, which is using the reconstructed tape to look at order size. So the chart on the left is representative of what I've shown you for the regular settings for the divergence indicator. And in this case, we're seeing an accumulation trade because the KP3 number was a negative 237. But on the right, what I've done is I've gone and taken the indicators and put the indicators so that there is no reconstructed tape and a minimum filter of 1, and place that on the chart. So as you can see, the difference between the KP3 numbers is the chart on the left, which was showing the accumulation, had a negative 237, and the chart on the right had a positive 816. Now, because the chart on the right is making a higher low along with the KP3 number, that's why we don't see an accumulation trade here. But the chart on the left, which is the chart that you would be using with my settings, showed a over 1,000 contract difference and gave us the accumulation signal, and which was of course an excellent signal to have taken and traded. So here's another trade that is the exact opposite of what we just looked at. Here we had a distribution followed by a bullish special divergence. Now, we had this non-divergent signal right there, but remember, these are looking at different numbers in how they're calculated. So because we're getting a bullish signal here, don't disregard it and say that, okay, I had non-divergence here, so I'm going to disregard this bullish signal. No, you're getting this bullish signal because we had different values set in the indicator. Now, again, what we want to look at is, let's look at the cumulative delta all the way from back here. So the cumulative delta, the KP3 numbers, increased by 3,893 at this point, increased by another 400 at this point, and increased by another 1,600 at this point. So what we're looking at is we're looking at taking this trade as a distribution, and again, there's no reason not to. But if this was truly a distribution, then we would have expected to see the bears come in and support that distribution and take price lower. When they're not taking price lower, and we see this KP3 and the KP2 number both being positive on this down move, we need to be out of that trade and obviously looking to take it long, because we got another 10-point trade out of this. The read on both of these trades is extremely important, because if you had disregarded the special divergence signal here, or in the previous example, you would have ended up taking a loss on this trade. And that's kind of why what you're looking at right here, why this distribution, we were actually getting the signal right there as it becomes non-divergent, and it is something that would be easily disregarded at that point. So here's another interesting example of an accumulation trade. And after the trade was made, we see that we did receive support in the cumulative delta, and the cumulative delta had traded higher. And then some very hard selling came in right here and took the market down, and actually took the cumulative delta down even lower. Okay, so this is why I point that out. Our first accumulation trade was occurring back here, and what I've done is I've changed the zigzags on the chart, and I changed it from 2.5 to 2.0. And by doing that, what I was trying to illustrate here is that when all those contracts got sold, taking us down to this lower low, if you had a different zigzag on the chart of 2.0, you would have been given this accumulation signal right here. And we didn't get it on the other chart because we had a 2.5 zigzag, and at a 2.5 zigzag we were one tick from creating a new zigzag, and without that creation of the new zigzag we wouldn't have seen this accumulation signal. So what you are to read from that is that if you see that on the chart where this is going and making a lower low, but price is making a higher low, then that is the definition of accumulation. They're accumulating contracts. And we can see that the value here that was accumulated was 1,232 contracts from this point here to this point here. So I know that is kind of advanced, but if you are understanding the numbers and are reading the chart, it becomes a little bit easier to understand what you are seeing in real time and not just relying on a trading signal that didn't occur because price hadn't traded one tick lower. And here's the chart back to the original zigzags. So the rule when we are trading an accumulation or distribution trade is that we want to see confirmation in the cumulative delta that the trade is going in our direction in order to confirm that this is a trade we should be in. Here's another example I found of an accumulation trade that market was pre-positioning at the open. Again, we see that we had our accumulation signal down here, and the KP2 number, which is the number that we want to see high, is a 571 here. So you have to ask yourself, do you really want to take this bearish divergence trade in light of the fact that contracts are being accumulated down here and pre-positioning on the open, and after your accumulation signal you received a very good KP2 number of 571. As you see here, the KP2 number, the sell-off down here was only a negative 273 contracts, and this is the reason for the ratio. Is the ratio was only a minus 24 per tick as we traded down and traded into support right here at the open. Here's another example. I have turned off the patterns, which is why you're not seeing any of the ZoneTraderPro price patterns. But here we have a exhaustion trading pattern, and as you can see, the cumulative delta did in fact decrease here by a negative 1,438 contracts. Well, what did that set up? It set up this next special divergence trade, which was again good for over 10 points. So to wrap up the idea of distribution and accumulation, what we are worried about in this trade is that the cumulative delta doesn't confirm the trade after we've made it. We want to be extremely careful for any type of special divergence pattern that we get immediately after making that trade. The second type of divergence trade is the special divergence, and we can see special divergence in two places. We can see it occurring here because we see the no supply label here, but in this case over here, where we have this special divergence trade, and the definition of a special divergence is where price trades from a high to a low or a low to a high. And remember here, we're getting this signal here, but we don't see the no supply signal like we did back here because of the different settings that we have on the divergence indicator. In this case, this bullish signal here is coming from the divergence indicator. Now, what is extremely important to understand is that because the special divergence is on a different zigzag, such as this right here, if you want to get paid every time, you need to respect that zigzag, as in this example. So this example here, with the zigzag set at 2 points, and if you want to have a winning trade, what you need to do is you need to realize that the zigzag is set at 2 points and set your target appropriately. So what I mean by that is price had traded to a low here of 83.75. Now, it doesn't matter where you get into the trade. A new zigzag, as far as special divergence is concerned, is going to occur at a price of 86. Right there. So if you want to have any chance to get paid in this trade, what you need to do is you need to adjust your target so that it matches the zigzag. If you were lucky enough to get in at the low down here, you got your 2.25 points. If you had entered at a price of 4.25, you should have immediately realized that price had been 2 ticks lower and adjusted a target to 86 even, and in that case you may have gotten filled. I wanted to add one more comment about accumulation and distribution, and I apologize for not doing this earlier when I was explaining the trade. The accumulation distribution, as I stated, occurs when we have a zigzag, as we do right here. When it becomes non-divergent, it becomes non-divergent at this point right here, which is equal in the price, irregardless of what the actual contracts are saying. So you need to keep that in mind. If you were taking a trade from here, well, it's entirely reasonable to put a stop maybe 1 tick or 2 ticks below this previous low in case they were running the stops here if you had initiated a trade from, say, right in here. That is something very common that I see, is that you'll have a busted accumulation signal, but price trades either to match the previous higher low or runs it by 1 tick. And I'm sure that you agree with me that the worst thing in the world is to enter a trade down here and put a super tight stop on it, only to see the price trade 1 tick lower to run stops, and you're one of those stops that has been run. So that's just a little bit more information about the accumulation pattern that we have here. The next and the last divergence is our typical divergence, which we see here in this bearish label and again in this bearish label here. And the mechanics of that are pretty simple. Once we have a higher high and we have a lower number of contracts, meaning the KP3 number, if that number is lower, we're going to begin receiving a bearish divergence. Now, the bearish divergence signal or a bullish divergence signal are the most difficult to enter and confirm. And I say that because on numerous occasions I've entered a trade based upon a valid trading signal from the order flow only to see price trade higher. And that is why we need both the delta strength and the order flow to look to confirm these bearish trades right here. Now that we have the KP3 number, which is reflecting the number of contracts from this point here, that may make that a little bit easier on when to take and when not to take a straight divergence trade. The last comments I have are involving when price is in a strong trend. When price is in a strong trend, that is easily defined because we've traded past this blue zone here. And in the new software, you're going to actually see a red warning label that says strong trend. What we're not looking to do is we would not be looking to take this short trade here because we're trading against this strong trend. And as I've stated in my other videos, and this is illustrated of that point, is I don't know where a strong trend is going to stop. So if we receive a counter trend signal while in a strong trend, this is something that we definitely want to ignore. One thing to consider is when you do have a signal that is in the direction of the strong trend. So as we can see back here, we had an 8:30 news release. Market initially traded down and traded up into a strong trend. Now in this case, this trade right here is a strong trend trade. A strong trend trade is defined as the market trading to this pink zone up here and then a pullback to the minor area of support right here. This is not normally a trade that I would be looking to take because of risk reward. However, if I'm being given a no supply here and then again a second no supply here, and I'm looking at this cumulative delta down here, well, these are both trades that I definitely would want to be involved with. The cumulative delta and the large lot traders are both supporting that trade, thus giving you a better risk reward scenario to enter that trade. And that's really all the thoughts and comments I have on the ZoneTraderPro Divergence indicators. I hope that you've enjoyed this video, and if you have any comments or questions, please be sure to send them to me and I will address them either directly or in a future video. Thanks for watching. Have a good day.